Financial disclaimer: the content in this video is for educational, informational, and entertainment purposes only and is in no way to be considered financial advice. Please research all material for yourself before investing, and if you wish, seek out a licensed and credible financial advisor. Enjoying this? Like, subscribe, hit the bell, share, and check the links below. If you had to choose between steady cash flow every week or explosive long-term growth, which would you pick? In today's video, we're breaking down high-yield weekly and monthly dividend ETFs like ULTY and MSTY and comparing them against growth stocks like NVDA, Tesla, and Apple, so to see which strategy truly wins, income or growth. Stay tuned to the end, because the answer might surprise you. Let's start with the income side, the dividend warriors. We're talking about a specific breed of ETFs engineered for one primary goal: generating massive income. Funds like ULTY and MSTY are prime examples, built to deliver staggering yields, often targeting 40% to 60% annually. This income isn't paid quarterly. It's distributed weekly or monthly, creating a steady cash flow stream. To put that into perspective, on a $10,000 investment, that could translate to somewhere between $400 and $600 a month in potential distributions. Of course, these figures aren't guaranteed and depend on fund performance and market conditions, but the appeal is turning a static investment into a dynamic, cash-producing asset. The engine behind this is a strategy called covered calls. In simple terms, the fund holds a stock and sells a call option against it. This is like being paid rent on your stocks. You receive an upfront cash payment called a premium in exchange for agreeing to sell your stock at a predetermined higher price. That premium is the income passed on to you. This creates the fundamental trade-off. By selling that option, the fund caps its growth potential. If the stock price skyrockets, the fund misses out on those explosive gains. It has traded the chance for a home run for the certainty of getting paid today. These funds run this strategy on autopilot, targeting volatile tech stocks like Tesla, NVIDIA, or Apple, whose options command higher premiums, fueling those massive potential yields. So let's break down the pros. The primary benefit is consistent weekly or monthly income, which is fantastic for retirees or anyone needing regular cash flow. This strategy also helps smooth out portfolio volatility, as the premiums collected can offset minor price drops in sideways markets. Now for the cons. The most significant is the limited price growth. In a strong bull market, these funds will lag. Second, those high yields are not guaranteed. They will vary with market volatility. And finally, if you spend the income, you miss out on the powerful compounding effect that drives long-term wealth. Essentially, ULT and MSTY are income engines, not rocket ships. Now, let's pivot to the other side, the case for growth stocks. These are the market's juggernauts, companies defined by ambition and future potential. They're expected to grow sales and earnings much faster than average, often by disrupting entire industries and changing how we live. Think NVIDIA, Apple, Amazon, or Microsoft. Their common thread: they reinvest their profits into innovation and expansion, not dividends. This fuels a relentless race for dominance through massive R&D, new infrastructure, and strategic acquisitions. They are funding the future, and as an investor, you're along for the ride. This reinvestment creates a powerful flywheel. As earnings grow, the company's value increases. Investors anticipating more future growth bid up the stock price. This is the magic of compound growth, not just on your investment, but within the company itself. Over time, their stock prices can multiply in value. Let's make this tangible. For example, $10,000 in NVDA just 5 years ago would now be worth over $120,000, fueled by the AI revolution. While this is an exceptional result, it perfectly illustrates the explosive potential when a company successfully captures a massive technological wave. Contrast this with a high-yield ETF like ULTY. It might have paid great income, but its price likely stayed flat or declined. That's because its covered call strategy caps the upside during strong markets and can lead to NAV decay over time. You get cash now, but sacrifice the potential for capital growth. So the primary pro is huge long-term compounding potential. You also benefit from innovation and expanding markets, investing in bits in the major trends shaping our future. This makes it a powerful tool for wealth accumulation over time, perfect for long-term goals like retirement. But the trade-offs are significant. First, there's no income until you sell. Your portfolio generates no cash. You must also accept higher volatility. Growth stocks have dramatic price swings, and you need the stomach to ride out the downturns without panic selling. And that means it requires patience and a long time horizon to let the strategy work and recover from those inevitable dips. Growth stocks are your wealth builders. They represent a bet on innovation. They might not pay you now, but with patience, they are designed to build the wealth that secures your tomorrow. So, which path is right for you, income or growth? This is a fundamental question every investor faces, and there's no single correct answer. The better strategy is simply the one that aligns with your personal financial goals, your timeline, and your tolerance for risk. Let's start with income. If your primary objective is generating consistent cash flow right now, income strategies are incredibly powerful. Think of retirees covering living expenses or anyone looking to supplement their paycheck. Funds like ULTY and MSTY are designed for this, providing regular distributions. This cash flow offers tremendous liquidity and a sense of stability, especially when markets feel volatile. It means you have cash on hand without being forced to sell your core assets at a bad time, which is a huge psychological and financial advantage. Quick reminder, like, subscribe, tap the bell, share, and explore the description links. On the other side of the scale is growth. If your goal is building significant wealth over the long term, this is your focus. Growth investing prioritizes capital appreciation, the increase in your assets' value. Instead of paying out cash, earnings are reinvested, fueling the magic of compounding. This is where your money starts making its own money, leading to exponential growth over decades. This path is ideal for those with a long time horizon who don't need immediate income from their portfolio. The trade-off is less cash flow and potentially more volatility along the way. These two paths represent different tools for different financial jobs. But what if you could have both? Many smart investors are now combining both strategies, using ULTY and MST for steady cash flow, and growth stocks or ETFs like QQQ, SPY, or VUG for capital appreciation. You can even reinvest the dividends from ULTY or MSTY into growth stocks, creating a compounding income growth cycle. This way, you're not forced to sell shares in down markets, and your portfolio keeps working for you every single week. So, which is better? For income, choose ULTY or MSTY. For growth, stick with top growth stocks or growth ETFs. For true financial freedom, combine both. Because at the end of the day, it's not about choosing between income or growth. It's about creating a strategy that gives you both. Cash flow today and wealth tomorrow. If you found this breakdown helpful, hit that like button, subscribe for more smart investing content, and comment below. Would you rather get paid every week or watch your wealth compound long term? Let's talk about it. Before you go, like, subscribe, turn on notifications, share this video, and check the links below. Before you go, grab my Kindle book, Get Rich by Investing by Craig Smith, CEO of the CRAIGTRADER Companies and a longtime investor with a finance degree. This practical guide helps any level of investor become better and more professional. The link is the first link in the description. Thanks for your support.